Just in terms of the run through for the presentation. So just looking back at 2003 for Momenta Finance, and then looking forward to what this year hopefully holds for us and for you as our introducers. A bit of a market overview and why we are more optimistic around the property markets and business environments this year than we certainly have been in the past 12 months. Talk specifically around why Momenta Finance could be a good potential funder to work with for you and your borrowers, and then get into the detail of the various eligibility criteria and sort of broad understanding of our various property finance products. And I think it's good to talk about bridging loans as part of that, just because that's where we've fortunately been able to raise significant funding. But as a reminder that we offer a full suite of property finance products, which I think are becoming more competitive in the markets. So just very quickly, looking back at 2023 for Momenta Finance, certainly an unsettling year, I think, for the industry and for all lenders. But as a business, we got off to a very good start in the year. There was some press release and PR relating to £100 million securitization facility that we raised from Barclays Investment Bank. And that was primarily to fund our secured and unsecured loan products. And we started deploying under that loan facility at the beginning of the year, and had some good results from that last year, despite a volatile lending market, as I've said. At the same time, we raised an equity funding line from Quillam Capital, who are a well-known equity provider in the UK. They have a portfolio of about 15 lending businesses in the UK, including other property finance companies, the likes of Tuscan Capital and Pivot Capital. So a very good funding story for our business going into last year. At the end of the year, we ended up originating over £50 million in new loans, which is a good number, not a fantastic number, but obviously that's against the backdrop of a very volatile trading environment. And of that 50 million, about £25 million were on our secured loan products, and we'll get to the details of what those products look like. We also had a good year in terms of hiring exceptional talent into the business. We now have Jeremy Crinnell working as one of our BDMs, who used to be the head of broker at Funding Circle. We have Tom Shave in the business, who held that position before Jeremy took over from him. And you've got me in the business, who held that position before Tom took over and then Jeremy took over. So sounds a little bit incestuous, but we really have a high caliber of BDMs in the business that understand the UK market, particularly the introducer and the broker markets. So looking forward into 2024 for the business, as part of this presentation, I'm very pleased to let you know that we have raised £100 million from a UK clearing bank, specifically to do bridging loans. So we have a lot of firepower in terms of funding to deploy, and hopefully that's an opportunity to work with everyone on the call to do more business together and deploy that funding line. So again, off to a good start with the year with the announcement of significant fundraising, and that funding line is live. There should be some press release and PR that goes out early next month to confirm it. But I think the very strong message to everyone on the call is we're open for business, we've got a very strong appetite, and we're ready to lend. It's not just bridging, as I mentioned earlier. There's a full suite of property finance products, which we'll get to. And in addition to the announcements around bridging and the wider property finance proposition, we will likely be launching our RLS3 products early in Feb. And that is obviously tailored more to secured and unsecured cash flow loans. But I think the RLS3 accreditation is a strong stamp of validity of our business as a whole by the British Business Bank and the funders that sit behind us. I think towards the end of 2024, you will see other products being launched by Momenta Finance that we're working vigorously on executing. And those could be an asset finance product, an invoice discounting finance product, a business credit card, TBC, but we're working very hard to expand our offering to the market and to you as our introducer, so that you've got more options to offer your borrowers when they approach you for business. And naturally, on top of all the stuff that I've spoken about this year, the business will grow, and we look to grow using our introducers and helping them grow by being able to fund more business with them. So just a quick market overview. I think it would be delusional of me to say that I think I know where it's going. I don't think anybody does. Obviously, talking about general business confidence improving as interest rates go down, and sort of the graph on the screen demonstrates that. Obviously, end of 22 and 23, very volatile in terms of high rates, which in turn led to less mortgage availability, lower property prices. And I think that created an issue for a lot of property lenders out in the market, which I'll get to later in terms of why I deal with us now. But I think overwhelmingly the sentiment for this year is lower rates, more confidence coming back, higher liquidity of mortgages, and that should hopefully drive the property market upwards, which means more appetite for developers and new schemes, etc., etc. So hopefully good news on a downward trend in interest rates will mean more business for all of us to get involved in. I think certainly my view from sitting in my seat is that it's been a very strong start to the year, and there certainly seems to be a lot more interest in new developments and a little bit more appetite to fund refurbs and development exit products as well. But we will see as the year goes. Lots of sort of bumps in the road coming ahead. The UK has an election, lots of potential flashpoints in the Middle East. And of course, there's a lot going over the pond where a complete madman might be in charge of the US again. So who knows how that might sort of affect the forward-looking reduction in interest rates that you see on the screen. But at the moment, that is the popular view. And the SONIA look-forward rate is important for us because I'll get to it later when I talk about the products. Most of our products are based on SONIA. So the borrower rate today, if the base rate and SONIA rate decreases as predicted on the screen in front of you, then those borrower rates will get cheaper for customers as those base rates continue to move downwards. So just on to why I consider using Momenta Finance as a lender for your borrowers and to consider us as a viable competitor. I know that everybody on the call has hundreds of options around in terms of lenders that will lend on bridging and other facilities. I think there's a couple of reasons why you should seriously consider Momenta Finance as a lender for your borrowers, especially on the property finance side. The team is very seasoned, headed by myself, who used to be the head of property finance for Barclays Business for the whole of the UK. And that was between 2008 to 2012, just when the credit crunch was really biting. And Eric Seville, who I mentioned earlier on the call, I remember endless days and nights of him sitting at Barclays underwriting credits and going through that stress. But it gave us obviously a very good insight into the market, the products, and we certainly understand it very well in our business, not just with me, but with the wider team. And it's the same team that was responsible for starting the property finance product and funding circle before they had made the mistake of stopping to fund deals on their property finance products. We are fully focused on new originations. I sort of alluded to it earlier. I think given the stresses on lenders in 2023, I think a lot of lenders sort of had to change their appetite given probably issues that we're seeing with their portfolio performance or their funding lines. And I'm sure everyone on the call probably had quite inconsistent lending decisions from borrowers. I'm sure they were dealing with a lot. The point I'm trying to get to is that we don't have the same legacy issues on portfolio that some of our competitors do, which allows us to be fully focused on new originations and building up as quickly as we can. So a lot more attention from us on new deals as opposed to managing existing portfolios, which I think is a big distraction for a lot of our competitors. Probably the biggest USP in dealing with us, certainly for 2024, is that you'll have direct access to the decision makers in the business. Unfortunately, that largely means me, but very happy to engage with any introducer one-on-one to talk about a deal very quickly, say whether we've got appetite for it and qualify in or out very quickly so that we don't waste time. And we don't have to go through the rigmaroles of PDMs, back office staff, credit committees, monitoring committees, etc. So I know every bridging lender says they do it very quickly and very accurately. We certainly do. And like I said, you can have direct access to decision makers to talk about your deals. As I mentioned earlier, funding for us is not an issue. We are probably overcapitalized in terms of the money that we can put up, which is a great problem to have, and we'll be very aggressive but sensible in deploying that capital. And I think that is a problem, if you want to call it a problem, that is very different to what a lot of our competitors are dealing with. It's been a very difficult period to raise funding. We've had some great results, but I think other lenders have struggled a little bit to raise the necessary funding to deploy what they want to in 24. And I mentioned it earlier, our rate is a variable rate product, so any deals that we fund sort of today are only going to get cheaper for the borrower over the next 24 months. And I think that's quite a strong selling point for you as introducers to sell to your borrower. There's lots of examples I can sort of cite around deals. We've seen pretty much everything at the moment. We've just funded a £1.5 million development exit deal up in Scotland, which was very easy to do. Took the first charge lender out, funded the remaining 250 grand to get to practical completion. And that scheme is already pre-sold under Mrs. Law in Scotland. And I think we transacted on that deal within 15 working days. It helped that the valuation was in place that we just needed to refresh to ourselves. And the solicitors on both sides acted very quickly. But I think that's a good example of how we can execute on sort of mid-sized tickets very quickly. So I'm just going to go through the individual products, not just talking about bridging loans, but the full suite, as I've said. Just an early warning that I don't think anything you will see here is probably different to what you'll see from other lenders. But again, I think the context is important around the funding that we have and the ability to execute. But I sort of want to give you an idea of what our eligibility criteria are up front so that you can sort of shape deals when you see them to say, potentially speak to Momenta Finance about this deal. So in terms of our new funding line from the UK Clearing Bank I mentioned earlier, we can fund bridging loans across the UK. Loan sizes up to 5 million and over 24 months. Purpose of the funds, the usual purposes, refurbishment loans, which I think is a big opportunity. It can be light refurb or heavy refurb. Equity release against properties that are already owned. Development exit, which I've already explained, and I think will be popular in the past because properties have been slower to sell. Existing first charge lenders probably want their money back. So I think there's an opportunity for everyone on the right scheme. You want to be careful that you're not picking up somebody else's problem, but there's a good opportunity there. And then bridging loans to purchase properties as well. We can roll up interest for the full term of the loan or have it serviced monthly from rental income. Obviously, if you are going to roll interest up, the term needs to be shorter because it's going to be a matter of time before you get to your 75% gross LTV sort of ceiling. So it helps if the borrower is able to service the interest and keep the LTV lower. A SONIA rate product, variable rates, as I've discussed. Rates currently, as of today, are about 1.1% per month. But as I said, they will move downwards as the SONIA base rate reduce. We don't charge early repayment fees. And in terms of the economics that we need to earn on the deal, it's a 1% fee on the way in. Anything that the broker can negotiate on top of that with the borrower is for them. And we charge a mandatory 1% exit fee, which is a requirement of our funding line. We're focusing on first charge loans only. We can do second charge as an exception, but first charge is the rule. And we do need a risk valuation on any property that we fund. And on developments, exits and refurb loans where there's a considerable amount of work or time to finish the scheme, we may commission a monitoring surveyor or at least an asset manager to do site visits for us and monitor refurb and development exit progress, and obviously validate the timelines to do that. And as I mentioned, we can go up to 75% gross LTV at the end of the term. Obviously, don't want to build our whole portfolio at 75%, but we can go up to that as a maximum leverage. Just before I get on to our development finance offering again, please feel free, if you do have any questions, to type them in the chat box, and Shannon and I will get to them at the end of this presentation. So development finance, similarly across the whole of the UK, including Scotland and Northern Ireland, you've actually got quite a few Northern Ireland deals going on at the moment, just because it seems like other lenders have retrenched out of that geography pretty quickly. Loan size of up to £4 million debt. That's a debt size, not a GDV size, just to be clear. 24-month term, and it's classical development finance, ground-up developments, refurb deals that probably don't fit with our bridging loan criteria, and development exit deals that also don't fit with our bridging loan criteria. At the moment, it's a fixed rates product, priced at 1.3% a month, with a 1% arrangement fee again that we need to take on the way in. There aren't any early repayments or exit fees on that facility, and sort of the maximum we'll go to in terms of the funding ratios is a loan to cost of 85% and 75% gross loan to GDV at the end of the term. Again, focus very much on first charge, and we require a risk valuation and MS reports where there's considerable construction risk and or refurb risk. I think if you look at sort of the loan size we can go up to, it's very much focused on affordable housing schemes, which takes you outside of the city centres, where you probably need, well, you definitely need more than 4 million to build anything decent, and you're probably into the home counties on smaller schemes where your pound per square foot GDV is probably anything from £300 to £700. So I think that's pretty vanilla in terms of bridging and development finance. Our secured loan product is a bit different, but I think there's a definite place for it in the market. So this product offering is focused on property assets that produce income, and they either produce income from rentals being in place on the property, or a commercial mortgage where I get to where there's a trading owner-occupied business in the premises. But let's just focus on sort of income producing assets from rentals at the moment. Again, we can fund across the whole of the UK. Maximum loan size we can go up to is 750 grand. But it's important to say that we can fund those deals on a first and second charge basis, and I'll get to an example of that later. Up to 24 months, and the borrower has to service interest on that loan facility every month from the rental income produced by the property. We can fund refurbishment of the asset that the borrower owns. We can give them access to equity that is built up in the property, and I'll cover that off in the example that I use. Or somebody wants to buy a property that is already producing rental income, we can fund up to 750k as a maximum loan ticket to assist with that. We can go up to 75% loan to value for residential properties, 65% for commercial properties, and the V in that calculation is the market value, not sort of any GDV or future value. And all we need to ascertain is that the interest cover can be paid one times by the rental income produced by the property. No exit fees and no early repayment fees, which is I think is attractive. So borrower isn't penalised if they want to refinance out at a later stage, or they sell another property, or they replace the whole debt stack with a new facility. So we're actually working on probably 5 deals like this at the moment, which I think are a good example to share with you. A block of flats that is owned just outside of London, with about 20 units in there that are all tenanted and producing rental income. There's a UK challenger bank in on all of those properties where they are the first charge holder, but they will only go up to 65%, and they provided sort of a 10-year amortizing loan, we can step in, go up to 75% loan to value, release that surplus equity back to the borrower to get on with their next scheme or whatever. And then we get serviced. We need to make sure that there's enough rental income that comes in from the property to service the first charge holder's amortizing debt, plus cover our interest cover for the month. And normally, if it's a good quality asset and the yields on the asset are right, all of the deals that we look at, there's more than sufficient rental income to service both of those debts. So apologies if I'm repeating myself, but where there's a first charge holder that are capped out to 65%, we can very quickly come in up to 75%, release the equity quickly, and we just need to make sure that the full debt can be serviced from the rental income of the property. We need to negotiate sort of a deed of priority with the first charge lender, but based on what we've seen, that hasn't been too much of an issue if the first charge lender is a credible counterparty. And then the last product I'll get to, and then I'll stop talking just before I get to the last slide, is a commercial mortgage for owner-occupied properties for SMEs. And just to be clear, this is not to compete with the commercial mortgages that are available from high street banks, sort of on 10 or 15-year terms at very low rates. I think the term that the industry is using at the moment is a stabilization loan, which I think is a good descriptor. What we can help with very quickly is equity release in a property that the borrower owns, or help facilitating a purchase that the borrower wants to undertake to expand their business, or they just want to refurbish their existing trading business in order to improve it. We can step in very quickly to give them access to that finance, up to 65% for commercial properties on a first charge only basis, 24 months. And again, it's an interest only facility. So all they need to demonstrate is that their business generates enough income to service our interest on a monthly basis. And then the exit for us is obviously once the stabilization of the property has happened, we can get refinanced out by a UK clearing bank with their commercial mortgage product. And there's no early repayment fees or exit fees on that facility. So it makes a lot of sense, I think, for the borrower to use us, stabilize the property, as I mentioned, and then refinance out onto much cheaper funding if they're a credit-worthy borrower, which they probably are if we've given them the finance. After that dramatic pause, I'll finish off on the last slide and then happy to answer any questions that anybody has. Just elements that are good to know, pretty much common sense, but obviously the stuff that we focus on is a very clear exit strategy on how we get repaid. A strong offering across all our products that I've just talking around no early settlement fees. So no penalty to the borrower for repaying us early, which I think every lender should welcome. We do have a very good panel of valuers and monitoring surveyors and lawyers that we can commission to act very quickly for us, which helps our turnaround time to you and your service to borrowers. And our offering does go across the whole of the UK. I've said it a number of times on this webinar, but I think that's a strong selling point as well. So just in terms of the way forward, if you have deals at the moment and going forward that you'd like us to look at, by all means, you can forward them to me directly. I'll look at them myself, just in line with what I said earlier around access to decision makers, and I can very quickly qualify them in, qualify them out, and issue indicative terms very quickly. Obviously, avoid going through huge due diligence just to issue an indicative term sheet. If those terms are attractive to your customer, then obviously get to the next stage of the more heavy DD that's required, and with the aim of moving to credit-approved terms pretty quickly on the back of that. The stuff that you'll need eventually is on the screen, and none of the stuff that you wouldn't expect to see from any lender who's doing a good job around a build appraisal, estimated values of the property, accommodation schedules, etc. But again, we won't be heavy on that information requirements up front. If all you're looking for is an indication of our appetites to fund a deal and what the potential economics of that deal might look like. I've spoken for 28 minutes, which is 2 minutes under the allocated time that I've had. Happy to answer any questions that anyone may have. Just as we do that, if we go to the next slide, Shane, there are contact details. And again, if you have any deals that you'd like me to look at literally after this webinar and going forward, my details are on there. Probably best just to email me whatever you have, and I can qualify it out pretty quickly and move to terms, as I've said, if it's attractive to us.